We're also a group of business owners that want to grow our businesses. We're all about learning from each other and from each other's companies, what our best practices are, and how each of us manage our day-to-day tasks, and how we overcome challenges, and how we take advantage of opportunities that come our way. We believe in referrals, and being a networking group, that's important to us. We don't solicit referrals or solicit that sort of thing, but we believe in making them organic. We get to know each other. We're a pretty close group, and we enjoy our visits, and we enjoy our meetings on every Wednesday morning. And so that's kind of what we're all about. We're, like I say, in summary, we're a group that's about growth of business and growth of our professional networks. So with that thought, that's why we do have our guest speakers out here. It gives us a great opportunity to meet other people like you folks. And when the day comes that we can meet in person, we will be doing so having breakfast. And until then, we're limited to Zoom. So Tom, I'd like to, if you could introduce our speaker for the day, I'd appreciate that.
Sure, thanks. Thanks, Gerald. So Hilliard, I'm just going to do a quick little bio for you here, and when I'm all wrapped up, if you're okay to start, we'll get started.
Okay, so I'm Hilliard MacBeth. I wrote a book called When the Bubble Burst, Surviving the Canadian Real Estate Crash in 2015, and then I did an updated edition, a second edition in 2018. So if anybody's thinking about getting the book after this presentation, please make sure you get the second edition, which has got red and black on the front. So hopefully in about the next 20 minutes or so, we'll.
Sorry, Hilliard, I'll just, if I could just read a bio for you so everyone knows who you are.
Sorry, I misunderstood. It sounded like you were telling me to go ahead. So.
No, no. So I'll just read your bio, and then then you can go ahead, just so everyone knows who you are. So thanks, Gerald, for the introduction of our club as well. So for those of you who don't know me, my name is Tom Dean. I do a lot to coordinate the guest speakers here at the Vantage Club. For this morning's presentation, we ask that everyone keep their mics muted. Please note that we have a comment sidebar. If you have any questions or comments as they come up, we'll also have a question period at the end of the presentation. So we ask that you don't interrupt during Hilliard's presentation. This morning, it's my pleasure to introduce you to Hilliard MacBeth. I first saw Hilliard speak at a Rotary event several months ago, and I was amazed to see his dexterity and skill in weaving together. I don't want to say a dismal or apocalyptic picture of the Canadian real estate market, but at the same time doing it in such a way as to not cause any fear or upset, which is so often the case in any presentation about economics. So by day, Hilliard provides financial guidance and portfolio management expertise to a small number of high net worth individuals and families. His involvement in the investment industry spans more than 42 years as a professional and 50 years as an investor. He currently acts as the Director of Wealth Management and a Portfolio Manager for Richardson Wealth. He's a former chairman of the Alberta Division of the Investors Dealers Association of Canada. He attained the Fellow of Canadian Securities Institute designation in 1981, winning the John R. Kimber Memorial Award for the highest marks of any Canadian industry student. Hilliard heads MacBeth McLeod Partners, a team of 5 professionals. He earned an honors Bachelor of Arts in Economics in the University of Alberta and took postgraduate studies in macroeconomics in Queen's University in Kingston, Ontario, and studied at the University of Grenoble in Grenoble, France. In 2007, he attended the Global Portfolio Managers Workshop in INSEAD near Paris, France. Hilliard visits conferences in Europe and the US regularly and continues to improve his understanding of the forces that influence markets. And if all of that isn't enough, in his spare time, he likes to publish his books. He published his first book, Investment Traps and How to Avoid Them, in 1999 with Prentice Hall Canada. That book alerted investors to the buy high trap of the dot-com bubble. Hilliard's latest book that he was just mentioning, When the Bubble Burst, Surviving the Canadian Real Estate Crash, came out in 2018. He describes the Canadian housing bubble, the reasons why serious correction is inevitable, and provides strategies to help Canadians survive the coming disruption. He lives in Edmonton with his wife Nancy and enjoys skiing, writing, research, and golf. So without further ado, Hilliard, you can take it away.
Thanks very much. As I was saying, as I prematurely was saying, there's a book out called When the Bubble Burst, Surviving the Canadian Real Estate Crash. This came out in 2018, and it has the red cover. So today what we'll do is we'll answer 4 questions. Why does Canada's housing bubble have to end with a hard landing? How do bubbles in other countries compare? Are Canadian families and lenders ready for a hard landing? And of course, most importantly to this group is Alberta Special. And so I just wanted to say, we'll get into that in just one second, but I just wanted to thank Tom for inviting me to speak to this group. And also, I'm very impressed with just looking at the numbers here, 42 Zoom meeting. I've been, obviously everybody's going through a really difficult time with these Zoom, and obviously our business and your businesses have been affected. Sometimes I get tired of these Zoom things, but it was really impressive to be presenting to such a large group. I have done a couple of presentations of this format, but I think this is probably the largest one. And it's different, of course, from what I used to do. It was quite a few presentations prior to that because of the books in person. So we'll see how this goes. So anyway, so the questions. Why does Canada's bubble have to end with a hard landing? We'll start with that. And
Hilliard, sorry to interrupt, but your slideshow is not showing. If you just want to hit resume slideshow, it'll probably come up.
It says here that the sharing is paused. I don't know what. Oh, here we go. That's my. How's that? Is that better?
No.
Okay, let's just figure out what's going on.
There you
go. Okay. Are we seeing questions about Canada now?
Yeah, you bet.
Okay, excellent. So why does Canada's bubble have to end in a hard landing? Well, first of all, we should probably define what a bubble is, because I've been doing this for quite a while now, and nobody has a really good definition of a bubble. And there's arguments about it. Obviously, the people in Toronto that I meet are convinced that there is no bubble in the housing market. I don't know about Edmonton and Calgary. I think they're in a little bit different headspace right now. So the best thing I could find, there's a fellow named Robert Schiller, and Schiller is a Yale economics professor, and he wrote a book called Irrational Exuberance, and he actually does a really good website where he keeps track of a number of things like housing and the stock market. This sort of his famous thing right now is the price earnings ratio for the stock market based on the S&P 500, which, by the way, shows a very significant bubble in the stock market as well. So I've been, as was mentioned in the intro, more than 42 years in the stock market business, and I've never seen a bubble that big in the stock market before. The one in 2000, when I wrote my book, Investment Traps and How to Avoid Them, was a big bubble, and it had a big correction. However, this one's even bigger, but that's not what we're talking about today. We can talk about that another day. So here's the symptoms that Robert Schiller described in an interview in 2013 for people to understand what a bubble is about. Rapidly rising prices. Well, I think maybe not in Edmonton and Calgary, but we can certainly all agree that Toronto and Vancouver have had rapidly rising prices for probably 20 years now. People tell each other stories in an attempt to justify the bubble. Well, definitely we have that. The story in Toronto, of course, is immigration. And we could talk in the question and answer period about why that's a gross exaggeration. But I'll just give you one little quick number about that story. Edmonton, Calgary have been growing, as this group probably knows, at more than 2% annual population growth up until very recently. We don't have the recent numbers, but it was 2.35 for Edmonton, I think 2.45% for Calgary for many years. And the highest Toronto ever got was just under 2%, about 1.75%. And the average was well under that. And now, of course, the Toronto population is growing quite a bit slower than 1.5. So when they talk about immigration, they're really not using the proper numbers, but it's as people say, people tell each other stories in order to justify their decisions to get involved in a bubble. The people that aren't involved, of course, experience what we call FOMO, fear of missing out, envy and regret. They aren't participating. This happens in residential and commercial real estate, obviously. The news media gets involved. Well, not too much recently, but up until about a year ago, I was doing probably 10 or 15 interviews a year, probably more, a total probably of over 100 interviews. So they like to get me on to make these dire predictions, which some people would say I was wrong and that we haven't had a crash yet, but I like to say I was early. So, and all bubbles are for mental illness. Well, the reason I put mental illness on there is because when you think about the word bubble, you think of those things that kids play with the soap bubbles, and it's all very innocuous and all fun, and kids love them and stuff. Whereas if you say words like delusion, mania, and mental illness, it gives a better description of what we're actually dealing with here, because we're talking about a lot of money, a lot of borrowed money, especially, and a lot of pain and devastation for families and for businesses if there is a bursting of the bubble. So here's the numbers. This is our chart. We do MacBeth McLeod is called Partners now. We've had a change in the name of our company, Richardson Wealth. And this chart I publish every month with the help of Fraser Betkowski, one of my associates on my team. And there's a lot of information on this slide. But if you look at the right scale there, the left, both the vertical scales, there's the number, the lines seem to sort of be congregating around 400. And the base on the far left in the lower corner is 100. So this is everything in this chart is indexed to 100. So the dotted line is the Toronto index. It's a 400 now, started at 100. So it's a fourfold increase in 20. It happens to be almost exactly 20 years, slightly over. And as the math people in this group will know, that's about a 7.2% annual growth. The red line, which is a little bit lagging a bit behind, has also gone up at about almost exactly the same rate. And that's the household debt line. And in a minute, we'll see how Canada compares to other countries. It's obviously when you increase the household debt by 7% per year, when the economy is growing at 3 or 4% per year, you're getting deeper and deeper into debt as a percentage of the income of the country or of the household. And that's what's happening. Vancouver, you can see, is almost 4.5 times increase, and the Canadian average is about 3.75 times. So it's all pretty close. The two numbers at the bottom, basically what we pay, how we pay for our real estate, whether it be housing or commercial, is out of income. And we can see here that income has not even doubled yet. So this is we took the median after-tax income, so to take out any tax break effects and things like that. And you can see that as time has progressed here over 20 years, it has obviously become a bigger and bigger stretch for people to be able to afford what they have. And then inflation, it would be a whole seminar on this, but isn't it interesting how house prices have gone up fourfold, let's just say approximately, and inflation has only gone up 1.5 times. So that's on 20 years, that averages about 2-point-something% per year over 20 years to get to 150 on the inflation line. And some of you may know that the biggest component of the CPI, the Consumer Price Index, is shelter. So housing costs, shelter, rent, that sort of thing. And so how is it possible that the cost of housing has gone up fourfold and the inflation has only gone up less than twice? So I could explain it to you. Maybe people want to ask about that. That's an interesting question. So one of the things that happened to me early on in this was I went to a seminar in New York, as I like to do from time to time, go to these investor seminars. And the guest speaker was a guy named Jeremy Grantham, and he runs the one of the largest institutional money operations based in Boston. And he's retired now. He's about 82. Brilliant guy. You can on the GMO website, you can get his quarterly reports for free. But he and his staff studied 28 bubbles in the history of the world. Not one of them escaped the hard landing. So the definition of a hard landing is that the bubble has to correct completely back to the trend line and usually beyond. So if you go back to this chart here, we could say the trend line would be, just to pick a little bit arbitrary, call it the lighter blue line, the median after-tax income. Well, that implies a 50% correction to get back to the trend line. And often these bubbles correct beyond the trend line, but let's just say get back to the trend line in order to wipe out that excess of that bubble. So how does this bubble in Canada, hopefully we all agree it's a bubble, compared to other countries? Well, we're not the worst in the world. Australia is actually even a little bit worse than we are, but you can see here that this is the BIS house price index. So it's a little different from the one that every country has its own individual index. In Canada, we have two. We have the Teranet National Bank Index, and we also have the the Canadian Real Estate Association Index. And there's one for each city as well. There's a lot of problems with these residential house price indexes, which we can talk about if you want. But anyway, the BIS uses some measure of that. I'm sure they get the data from the CREA to a degree. But they try to standardize it around the world. And you can see, obviously, Canada's gone up since 1970 from 100 to about 2,700, or a 27-fold increase in house prices. Australia is a 45-fold increase in house prices. The US had a bubble, which was up to about 14 times, about 1,400 on this index, and dropped all the way down to 900. So there's your roughly 50% correction that caused the global financial crisis. Everybody remembers 2008, 2009. Several banks went bankrupt. Several other banks in the U.S. should have gone bankrupt, but were rescued by the government. GM, Chrysler went bankrupt. A whole bunch of implications in the financial markets. In England, all the banks except one, Barclays, went bankrupt, and Barclays was discovered to have been cheating. So you could say they went bankrupt too. In Canada, though, amazingly, our banks made it through. They got some help behind the scenes that we can talk about if you want, but they managed to make it through pretty well intact. But you can see on this chart that that correction in the U.S., which we all watched, it officially was around 40% drop in house prices across the United States. Doesn't look that big on this chart. If you go back to the 1990 range, you can see there's a green line there that says Japan. And this is a correction that's been playing out for about 25 or 30 years. And their peak was the peak in the economy was around 1989. The peak in real estate was a little bit later, a couple of years later. And they've been deflating ever since. And then in Germany, there's almost been no bubble at all. Now, this is such a long-term chart. There has actually been a recent uptick in Germany. And if you talk to German people, they get really upset when you say there's never been a bubble in Germany. But you can see that gray line sort of trying to get up to about 500 there, but it's nothing compared to 2,700 for Canada. And there's reasons why Germany is different. So of all of that, one of the things I wanted to make sure that people understood, and it occupies a big part of the discussion in the book, is the debt. So as we know, without debt, real estate would not exist in its current form. There would be very few people buying houses. There would be very few house prices would be much lower, and it would be very difficult to do all the things that you do and everybody does without debt. So there's a chart that, again, BIS puts out. And BIS, by the way, is based in Switzerland, and it's supposed to be kind of like the central bank of all central banks of the country. So private debt to GDP ratio and the growth rate over 5 years. And the reason I show this is because some great research by another person showed that when the debt level gets over 150% debt to GDP ratio, and if it grows at a 17% annual rate over a 5-year period, there's always been a financial crisis in every country that's experienced this. So we can see that Canada in the middle there in the shaded area is in the danger zone. So that the actual private sector debt to GDP ratio. Now, private sector, by the way, includes corporations as well as households, although it excludes bank debt, is about 220% of GDP, and this is up to about the third quarter of 2020. It's gone up quite a bit since then, actually, but we the pandemic is part of that, I guess. And the growth rate was above 17% recently in a period. There's very few countries in that situation. Even Australia, we saw the housing bubble in Australia. They didn't quite. They're just outside of the danger zone. And of course, China is the big one. It's way deep into the danger zone. But the problem with China is that we can't really tell the difference between private sector debt and government debt. It's a very blurred line. There's some very large corporations in China that are ostensibly private, but essentially they would be an arm of the government if we knew the whole story. So really, leaving out China and Hong Kong, Canada's got the #1 spot in private sector debt to GDP ratio. And the reason that matters is that governments generally cannot go bankrupt. The Canadian government is very unlikely to go bankrupt. The US government's very unlikely to go bankrupt. But everything in the private sector has the capability to go bankrupt. And as we've seen over the years, not so much recently, but in the past, we've seen multiple examples of financial crises that lead to some pretty large bankruptcies in the private sector. So here's the, I mentioned that chart was a little bit old. Here's the more up-to-date one. Now this goes right to the end of September 2020. So takes the pandemic era into consideration. And you can see on the sources that BIS is in there, but they've got some other sources as well. And there's been a huge increase in the debt to GDP ratio. Now, in most cases, the increase has been mostly governments, as everybody is aware. The government of Canada is experiencing a deficit of around $400 billion, which is basically doubled the government debt pretty much in the space of just 1 year. But in Canada, unlike the other countries on this chart, we also see non-financial corporates, which is the light blue, have also gone up substantially faster than any other country in the world, and also households. So Canada's got the #1 position, and not just by a little bit, but by a very large margin. And the other distinction is that we've managed to put the government much deeper into debt, but also corporations and households. And remember, we were already in the danger zone before all this happened. So this is quite alarming and also quite surprising to me. I'm of course pretty close to this because of the book and the interviews that I've done, and this is pretty shocking stuff. And it doesn't get any publicity, you know. I'm sure that this is probably the first time most of you have seen anything like this. The media story the media has been telling is that Canadians have record savings, right? So again, we could talk about that in the question and answer period. How is that possible that people have record savings if they're going that much deeper into debt at the same time? So here's another one. Now this is quite recent. The legend on the bottom shows Q1 2020, but it goes to Q3 2020. Goes back to 1970. Some of the same information that we saw in the first chart is included in this. Household debt to GDP is the red line in Canada. But what's interesting is how Canada and the US were quite similar prior to the global financial crisis of 2009. And Canada made the decision to go deeper and deeper into debt at the household level. And the US went through a massive correction. Now, the drop from 100% in the blue line there down to about 70%, and then back up to about 85%, I guess, wasn't done by a whole bunch of households deciding, oh, gee, I'm going to pay down my mortgage, I'm going to pay off my car loan, I'm going to pay off my credit cards. That's not what happened. People generally cannot do that because they don't have the income available to them to actually pay down their debts that rapidly. What caused that massive drop, of course, in household debt to GDP is bankruptcies and foreclosures. And of course, when the house gets seized, the debt gets wiped out. And so that's how that was accomplished. And I'm pretty sure that's how Canada's going to get out of this situation as well. But this latest, you can see that red line on the chart goes almost vertical. And that is, I mentioned earlier on that the average is about 7% growth in household debt over the last 20 years. For a couple of months in October, November of 2020, so about 4 or 5 months ago, the annual rate of growth in mortgage debt in the households was 12%, 1% monthly, 12% annualized. It's just a phenomenal situation. And I don't have a chart on it. It's really difficult to get information, but my guess is that people took the CERB money and all the subsidies and all the government transfers that were given to them and took that money and used it to buy real estate. And we could see that in the jump in the house prices in the last couple of months. This is not what I'm sure the government expected. It's kind of horrifying, actually, when you consider how overextended people are in the housing market. And but that's what happened. So here's again, we're still comparing to other countries. We can see in the upper right corner there that Canada's credit bubble is on this chart anyway, the biggest current one. We can also see in the past what happened when people had these household and corporate debt bubbles and how their situation crashed. And you can see the US one, for example, in the middle there, US housing bubble, global financial crisis. And you can see that the Canadian bubble right now is not bigger than the worst ones. It's equal to the Japanese one in the 1980s, which, by the way, is still correcting 25 years later. Because it must be close to 30 years now. Spain went through a terrible housing bubble and a crash, and now Canada. You can also see something that's interesting there, and they sort of ignore China, but Australia has started to take measures to try and lessen the degree of the debt, the household debt and the corporate debt. And Canada, of course, hasn't done that. And this chart does not include that recent surge that we just saw here, the vertical red line there. This chart would be up until prior to the COVID-19 pandemic recession. So hopefully you're in agreement that Canada's in a serious situation with a household and corporate debt bubble. And the question then becomes, are we ready for the consequences? Are we ready for a hard landing? And can we avoid a financial system crisis? Well, interestingly, about coming up to 2 years ago, the Bank of Canada did a severe stress test. It was in a staff paper, so it was only noticed by people like me, but it was pretty incredibly prescient because a few months later, the recession hit because of COVID-19. And so what they assumed in the, if you see the top line across it, it's called the adverse scenario. And they basically took the worst of the worst in terms of a recession and tried to model how bad would it be. And you can see on the far right, you've got a house price correction of 40.9%, minus 49.9%. Now they're not forecasting that, they're just saying, what if we had the absolute worst possible outcome and how bad would it get? And so the decline in real GDP, 8.2%, which is way worse than any previous recession, was actually accomplished during the COVID-19. I'm sure when the Bank of Canada staff did this, they had no idea that there was a COVID-19 recession coming. None of us did. The recession duration, well, we don't know yet because there's been no mention of whether we're out of the recession or not, but obviously we're at about 4 quarters of recession. In Alberta, it feels like we've been in recession since 2015, but officially for Canada, we would be at about 4 or 5 quarters now if it started in January of 2020. So the worst was 7 quarters, so we aren't there yet. Unemployment rate increase. So that's basically saying if the unemployment rate was 5% before the recession started and it went up to 11.4%, 6.4% higher, that would be an increase of 6.4. And we obviously had that. The peak unemployment rate, 12.6%. I haven't checked whether we actually got that high in Canada, but there's a problem, and that is that the definition of unemployment, in order to be included in the unemployment numbers, you have to, when they do a phone survey, and when they phone, they ask, are you currently looking for a job? Well, in the COVID-19 recession, when the lockdown was at its worst, people would be crazy to be out, pounding the pavement looking for a job because nobody would obviously talk to them anyway. So I think the better number is how many people are actively employed, and so that number I'm sure was reached 12.6%. In Alberta, we've been that close to that for quite a while now. But the one big one that has not been anywhere near, in fact, the opposite has happened, is the house price correction of minus 40.9. So the others, I would argue, are pretty much on track to occur, except for the house price correction. Now, the 1981, if you look at the bottom line, 1981-82 recession, that was the worst recession by far of any of the recessions since the 1930s in Canada. And we've exceeded pretty much on every measure, except for the duration of the recession, all of the numbers in that one. It says 6 quarters, we're only at 4 quarters now. And of course, the house price correction has not been achieved. I think it probably was a year ago at 9.8% temporarily, but then it quickly turned around. So what does that mean for banks? So this is a little bit too in the weeds, I guess, but it could affect people in the commercial real estate industry. So I thought I'd include this one. I gave a talk to a group of bankers coming up to 2 years ago now, and I showed them all this thing, and they were very hostile. It was in Toronto. I have no idea why the conference organizers asked me to be the keynote speaker, but they did. And again, this is from the Bank of Canada, so it's pretty accurate. So what they assumed under that adverse scenario, going back here, including the house price correction, is that there would be some losses in the debts that the banks had outstanding. Consumer credit, car loans, HELOCs, everything. The one thing they assumed, though, under this, is that nobody would stop paying their mortgages. So they assumed no losses based on mortgages, but it's pretty substantial losses based on everything else. And what that ended up to being is about 100 billion in losses. What that does is it takes the bank's capital. The inside baseball term for bank's capital is CET1, which stands for Common Equity Tier 1 capital. It's the only kind of capital that the banks have that was proven to be useful in the 2008-2009 crisis. The banks generally are at 12%. You can see the second line there, 12%. And so this turned out to be pretty accurate. And the drop would be down to 8% if they lost $100 billion in bad loans as a result of any possible crisis. That, in other words, they would lose about a third of their capital, and that would trigger under the regulators' rules, unless they agreed to waive the rules, which happens all the time, by the way, that the banks would have to suspend their dividends. Now, what actually happened in 2020 was the OSFI, the regulator, said that the banks must suspend their dividend increases. So if there was any suspension of Royal Bank of Canada pay its dividend, and that goes all the way back to 1860 or something, it would be pretty big news. So the fact that you haven't heard anything about them suspending their dividends, a pretty good trigger signal that they haven't done that. But this, again, remember this said, assuming that there were no losses in the mortgage book, which is pretty an amazing assumption when house prices go down 40.9%. They justified it by saying, well, the history in Canada is that Canadians keep paying their mortgages come hell or high water. They never stop paying their mortgages. But I think, you know, it's pretty far-fetched to suggest that if house prices dropped almost 41%, that some Canadians wouldn't look at their house and say, why are we paying this mortgage? And we'll never get out from under it. But you never know. There is in Canada, as everybody knows, the right for the bank to pursue the individual household for the loss if the house is sold for less than the value of the mortgage. There hasn't been a lot of that. That hasn't been tested since the early 1990s, so we don't really know how it would work if it happened again. And as a result of that, here's what the three big banks, so they talk about the big six banks, but in reality, there's the three top banks, and then there's a big gap, and then there's the other ones. So Bank of Nova Scotia, Royal Bank, and TD are the biggest ones. Generally, the Royal is bigger than the other two, but it kind of flips around. TD's generally recognized to be a little bit bigger in real estate. Royal Bank is very big in households, and Bank of Nova Scotia is a little different because it's bigger internationally. So you can see in previous crises like 2000, 2002, the percentage of loans that they took as provisions for credit losses. So this is what the bank expected to lose against their loan book if there were some bad loans, peaked out at above 2% just for TD. And for the other banks in several crises going back to 1980, you can see, although there's a couple of spikes above 1%, but they're pretty short-lived. Royals jumped up to 2% in early 1990. That would have been the Olympia New York bankruptcy. Some of you might remember that. That was pretty horrific. And then there's a couple of the banks got up above 1.5% in the 1980s. Those of you in Alberta that remember this, there were two banks that went under. There was Principal Group that went under. There was a whole bunch of oil and gas companies went under, and then a whole bunch of smaller private companies went under, and the banks were involved in losses and all of that. And then in 2009, the peak, none of the banks actually hit 1% of their provisions for credit losses. And then recently, and this is pretty amazing to me actually, because this is taken right out to first quarter of 2021. The most they've done is 0.5%, and actually a couple of banks lowered their provisions almost down to 0%. So what that means is they're actually saying that they over compensated for potential losses, and they're starting to reverse their provisions, and that's why it would go down that low. So again, this is the second biggest shock in the last year is probably the fact that the banks are actually lowering their loans loss provisions. So when you see a headline in the Globe and Mail or wherever saying the banks are have really strong capital and they have really good buffers for any kind of recession or loan losses, hopefully you'll remember this chart and realize that it may not be true. In fact, it might be exactly the opposite. Banks all over the world, I don't have a chart for it. Banks in other parts of the world have much, much larger provisions for loan losses than the Canadian banks. If the Canadian banks were here right at this moment, they would interject and say, we do it this way because we haven't had the losses. Even some of these provisions going back to 2000, 2009, they provided for 1% of loan losses, but they actually never reached that level. So they could make the argument that why should they have high provisions for loan losses when there aren't going to be any loan losses? This shows you, again, you'll see those headlines about the Canadian banks are the safest banks in the world and have the best capital buffers. That is complete BS. And this chart shows it very clearly. And I suspect this is a bit of a shock because honestly, the Canadian media report all the time that the Canadian banks are the safest. There's only two banks in this list, which is a pretty long list. I don't know if we got all of the banks in the world on here. Obviously we didn't, but we don't have any Chinese banks on here. Well, we've got a representative of all US banks, European banks, Canadian banks, Australian banks. And Canada occupies, the Canadian banks occupy 4 of the bottom 6 positions, and then the national bank's a little bit higher at number 9 or something like that. And then the Royal Bank, to its credit, is up around 12%, but most of these banks are sort of down around 11, 12%. And this is up to the 3rd or 4th quarter of 2020. So we'll update this in a couple of months. And you'll remember from the earlier chart that that Australia was a country that had an even bigger housing bubble than Canada. And you can see that the Australian banks, the dark blue are the Australian banks. There's only 4 of them, and all of them are well above the world average, which is 13.8%. You can see the Canadian banks are around 11%, 12, the biggest is 12% of capital as a percent of total assets. But the Australian banks were forced by their regulator to increase their equity capital, the common equity tier 1 capital. The Canadian banks were never forced to do any of that other than the suspension of dividend increases, which doesn't really improve the capital of a bank. It just kind of slows down the deterioration of the capital of the bank. So last section, we'll be quicker on this hopefully, and then we'll get to the questions. Is Alberta Special? Well, before we get to that, I should point out that these capital ratios and this percentage of loan loss provisions, it includes a fairly big chunk of Alberta in here. Alberta obviously being the part of Canada that's been in the biggest trouble because of the downturn in the oil and gas industry. And Royal, TD, and Bank of Nova Scotia have all said that they don't have any problems in their loan book in Alberta. And obviously they haven't taken much loan loss provisions for those based on this. However, Alberta, as people probably know, with only 11% of the population in Canada, is actually about 20% of the economy. So all of these banks are quite involved in Alberta. And of course, there's Canadian Western Bank, which I don't have on here, I don't think, and Alberta Treasury branches, which we don't know. I think they do publish their information, but I haven't checked what it is. It's, of course, 100% owned by the government, so it doesn't really matter. So anyway, here we go. So I mentioned earlier the growth in Calgary and Edmonton. So this chart's a little bit, so the vertical bars are the size of the population. And then in the fine print along the bottom there is the growth. Now the last census was taken in 2016. The next census is going to be 2021. It actually comes out, they do the census in May of 2021. And we'll start seeing the numbers on population growth, thing like that, in about September, October. So we're about 6 months away from getting an update on this. And the reason I don't use the numbers that we were talking about, bubble symptoms and people telling each other stories, is the growth of cities in Canada is very suspect in between census because it's very hard to measure the growth. Statistics Canada actually has a convoluted way of figuring out with tax domicile and all that, but it takes 2 years of taxes, and it's so I think we could pretty well say that these numbers probably haven't changed too much. So on the left, Toronto, in spite of all the stories about how fast it's growing due to immigration, over 5 years grew 6.2%. So that's just barely above 1%. Montreal didn't even make 1%. Vancouver, again, just barely above 1%. Calgary, 14.6%. Now that's a pretty amazing, as I mentioned, that's 2.5% probably per year, maybe even a little higher than that, almost 3%. Ottawa didn't even make 1%, and Edmonton 13.9%. So Calgary and Edmonton, as you people probably know more than most people, have been growing very fast. And this is obviously at 1.392 million and 1.321 million. This is not just the city, but the surrounding areas, the adjacent communities as well. And yet house prices did not increase during that period. So here's Toronto, who likes to talk about their population growth. But again, the bottom orange line is just that information taken over a little bit longer period, but it's about a 1%, 1.5% growth. And house prices, as we saw, this is the same data, almost fourfold increase in 20 years. So it wasn't population growth that pushed Toronto prices up. On the other hand, Edmonton, as we saw, had a almost 15% growth in population, but house prices actually peaked out in 2007, and they're actually a little bit lower than they were then on this index. So everybody knows 2000s, from about 2005, 2007, house prices in Edmonton doubled, and then they've been basically pretty flat ever since. So population growth does not necessarily imply house price growth. Calgary, the peak was a little bit late. They had a peak in 2007, like Edmonton did. Then they had a second peak in late 2014, early 2015, before this latest round of oil and gas problems arose. And now Calgary's back down to where the house prices are pretty much flat over the full period. And yet we saw that Calgary was the fastest growing population area in Canada by, other than Edmonton, by quite a bit. So I gotta stop on this one. So I just for fun, I looked at the area of Edmonton. Now this is arbitrary, 1963, which happens to be the year I entered higher school. So I took the rough area of development in Edmonton, and it's pretty arbitrary, as 132 square kilometers. I thought this might be interesting to people. And then in 2014, we did this a few years ago. Edmonton's obviously grown since then. I kind of took like the Henday as the, you can see the Henday ring road on here as the area. And of course, we all know that the formula for area is pi r squared. So when the area goes from 132 kilometers to 1800 kilometers, that's because the radius of the circle is grown out, and then you take, and it becomes exponential growth. So if these are accurate, and then obviously there's some question marks about how these lines were drawn, the area of Edmonton grew 13-fold over that period, 1963 to 2014. And the population, now this is just the city of Edmonton, grew from 303,000 to 877,000. So just about triple. And if you took the greater area, obviously it would be a little bit more than that. It might be 350,000 to, well, that number from the previous slide was about 1.3 million. So fourfold increase. So the population grew fourfold, but the area of the city grew 13-fold. And I think we can say, because we had to go out to the west of Edmonton yesterday, they're building houses well on the outside of the ring road now, of the Anthony Henday ring road. So I think it's pretty fair to say that Edmonton may have grown even a little bit more. And the point I want to make here is that the density has gone down by a factor of 3 or 4 times. So Edmonton is 3 or 4 times less dense than it was in 1963, which has implications for the value of land. And up until recently, the value of land in Edmonton had been rising for that whole period. But there is obviously a lot more land when you extend the aerial coverage of the city out that far. And that could affect the value of that land at some point as well. So here's my contact information. I'll leave this one up. There's the cover of the book. Second edition, 2018. Twitter, I'm very active on Twitter. I would like to point out too that I do a weekend note, which covers, it isn't just real estate topics, it's a bunch of other topics as well that we cover. And then there's our website as well. And those weekend notes are put up on the website. I tweet out, it usually comes out on Friday afternoon. And if people are interested, they can sign up for free to get that weekend note as well. So I'll stop there and I look forward to some interesting questions. Thank you.
Thanks, Hilliard. That was very good. We already have some questions in the sidebar. So I guess let's go through these from the top. So in one of your slides, you mentioned that Japan's Japan and Germany were much lower on a particular metric. As far as I think it was debt to GDP ratio, something like that. What was the reason for that?
So Japan is very different in that some of you will know this, but Japan's housing market and I guess the commercial real estate to a degree as well. There's families in Japan that have owned the house that they live in for 1,000 years. So the people that inherit the house have this incredibly huge burden to not lose the house. You know, to be the first person in 1,000 years in your family to have, you know, over mortgaged the house and then lost it would be, and there are suicides related to this in Japan. So that's unusual, and that's not obviously like Canada. So let's just maybe set that aside. Germany, on the other hand, is kind of interesting because there's a couple of things that happen in Germany that I think contribute to the fact that they haven't had a big housing bubble. There's sort of a bit of an uptick happening now, but for decades there was nothing. First of all, only about half the people in Germany own their houses. The other half rent, and the protection for renters in Germany is extremely strong. So you cannot be evicted in Germany. You do long-term rents. It's very wealthy families in Germany that rent their property. They don't own it. And if you want to become a homeowner in Germany, you go to the bank. There's no government involvement. There's no CMHC, and there's no first-time home buyers and all that kind of stuff. And the conversation starts at about a 30 to 40% down payment. So if you can't walk in with that kind of chunk of capital, there's no talking, because the bank, unlike in Canada, the bank is taking all the risk. There's no CMHC insurance for the bank in Germany. The second thing they want to see, which is quite interesting, I think, is kind of paternalistic, I guess, but they want to see a 2-year record, month by month, of your revenue in the household and your expenses in the household to show that you're living within your means. So you're not going deeper into debt. You're saving a little bit of money every month. And then they go and talk about your job. What are the prospects for your job? How secure is your job? What about your family? Do you plan to get pregnant? You're going to have any kids? It's very different, and from what we do in Canada. And so I think that's why the residential debt levels are much lower in Germany than they are in Canada.
Okay. Sarah Esler, I think you had a question. I don't know if you want to, if you're still on the call, if you want to ask it yourself.
Sure, thanks. It was really more about your chart talking about the corporate credit that's increased over the last, call it 12 to 18 months. I'm just wondering if you think a factor in that is the government backstop, that they've said that they're going to, buy those corporate bonds and that corporate debt, and whether or not you see that now that they've mentioned that they're going to start tapering that off, what the impact will be.
So that's a great question, and I think there is some of that. There's also something that happens. I don't know if any of you did this, but I did it when the COVID-19 recession hit. We have a line of credit, I guess, like everybody else does now, and I went and just drew the whole thing out. So limited it right out. I just put the money in the bank account and had so sitting with several $100,000 in the bank account, because in March of 2020, we didn't know how bad this was going to get. And of course, if you don't draw a credit line, the bank has the right to reduce it. And in previous recessions, they have reduced them quite substantially. So I wonder if some of that for the corporates is precautionary borrowing, if you want to call it, where they just draw down their line of credit as much as they possibly can. But obviously, some other corporations are in trouble. It's absolutely flabbergasting to think about the number of corporations that are struggling right now, and yet have hardly been any bankruptcies. So somebody must be willing to lend the money. I think there's possibly a direction from the government to the banks to say, lend freely. I have some anecdotal evidence of that, but I can't prove it. Lend freely to people that you normally might not lend to, because we want to get through this, or want to help people get through it. But yes, but actually, one more thing, the corporate debt was increasing faster than household debt for the last several years prior to the COVID-19 recession. And obviously, with interest rates as low as they are, have been even before this latest drop down below 2%, some corporations probably decided that it was a good time to borrow, even maybe if they didn't even need the money, but just that they felt that it was a good time to get some money.
Ahmad, I think you had a question related to the Bank of Montreal.
Yeah, thank you, Tom. Yeah, no, my question was, Bank of Montreal predicted that Alberta will be seeing a growth of about 6% for 21, with the projection for the economical growth. And our housing market has been pretty steady on the existing supply and pricing, plus the low interest rate. So with that kind of projection, I could see personally that's going to be a jump on investing in homes for potential renters in the future. But would that be contributing to a bigger bubble in Edmonton? Do you think if they go to the 40% adjustment?
Edmonton, so, yeah, the 6% growth in Alberta is a rebound kind of a growth, and the whole predictions of growth. We don't actually have a chart. It's interesting. It didn't include a chart on the depth of the recession, but the depth of the recession was much worse than 1982. I think if we go back to that, see if I can find that here. Yeah. Okay. So in the lower left corner here, it was minus 5.4%. That's peak to trough for the GDP in 1981-82. And of course, I remember this. Probably none of you are old enough to remember this, but it was bad. I mean, it was really bad. Companies like Dome Petroleum going bankrupt. I mean, it's hard to describe how bad it really was. I mentioned 2 banks going bankrupt, Principal Group going bankrupt. I just like the list is all the trust companies went bankrupt, and that was 5.4. Well, this current recession was much worse than that, from peak to trough. But it was because of the lockdown of COVID-19. So you lost all the restaurant revenue, you lost a bunch of revenue in the retail stores and all that sort of stuff. So so we're obviously going to have a rebound after something like that. And so that's the 6% growth this year is not particularly strong when you consider how deep we went in this recession, much deeper than any other recession. So and then the housing, going the wrong way. Make people dizzy with flipping through these slides here. Edmonton house prices. Okay, so is Edmonton in a bubble? So I didn't do this today, but one of the things I discovered over the last 5 years is if I say to people that there's going to be a housing crash because we're in a bubble, they get hostile, right? So what I would do at the beginning of a talk is I would say, you know what, Toronto, if you're in Edmonton, you say, Toronto, oh God, terrible bubble, huge crash coming. Vancouver, even worse bubble, huge crash coming. But Edmonton is going to be okay. Don't worry, Edmonton is fine. And then everybody relaxes, right? And then I say, I'm just kidding. Edmonton's going to be crashed too. So and hopefully they laugh at that point. But joking aside, people have a tendency to believe that their particular city or their particular neighborhood, or even I've had people tell me right down to the street level that there's something so special about their house that in a 40% housing crash, as the Bank of Canada was modeling, their house would not go down in value because it's special. It's got the south exposure in the backyard. Anyway, a bit of long-winded answer to your question. Edmonton house prices have been flat for so long now that to some extent the bubble has been erased from Edmonton. It obviously was in a bubble in 2007. It was still in a bubble in 2014 because then we got hit with that horrendous correction. I still think Edmonton house prices will come down a little bit, but nothing like the so seriously, not joking. I don't think the Edmonton house prices will come down like what needs to happen in Toronto and Vancouver, but they will come down. I'm shocked almost every day by the optimism of young couples in Edmonton, because I live here. Those are the people I meet most of the time about real estate, given that nobody's made any money for so long in Edmonton real estate in the housing index, at least if you believe this index. But people are still, I know some young 35-year-olds that are renting and haven't bought yet. And they tell me that their peer groups, their friends, are absolutely after them almost every day to buy something. They think they're crazy to be renting. But if house prices come down or even stay flat, it's actually a little bit cheaper to rent. If you can stand the constant threat of eviction and the problems with landlords and all that sort of stuff, renting is a little bit cheaper. But no, I think to answer your question, I think that I'm less optimistic about a rebound on prices than obviously there's quite an optimistic tone right now. But I also don't think that we'll see the 40 or 50% crash that Toronto's going to see in Edmonton.
Thank you for that. I guess it's sort of a follow-on to that question. And just a sidebar for myself, I'm 34 years old and I'm still renting Hilliard. So
all right, go for it.
There you go. So the follow-on question to that was from Bob Graham. And he said, you've been predicting this since around 2015. What do you think the catalyst will be, or is there a particular event in the future that is going to kick this off?
So great question. So there's some people in Toronto that are accusing me of being wrong. And I don't, obviously I get all defensive but I prefer the word early. So, it's the catalyst, if you look at, and I've lived through all of these, 1981, 1987, 1990, 2000, the dot-com bubble, 2008, 2009, the Lehman Brothers crash and the global financial crisis. If you go back and then researching for my books, going back to 1929 and different events like that, even years after they happen, people are still debating what the catalyst was that caused it. So it's like everybody just wakes up one day and says, holy cow, I'm about to buy $1 million house with $900,000 debt and my family income is $150,000. I must be crazy. I'm not going to do it, right? And if a whole bunch of people all at the same time, all of a sudden wake up with that attitude for whatever reason, then that's what triggers the downturn. Because and so we'll never know what the catalyst was. I would have thought that the recession in a year ago, March 2020 started, was going to trigger the 40% drop in house prices, and that didn't. In fact, the opposite happened. The government gave, I didn't mention, but there was a lot of income that with a drop in the GDP, obviously households lost a lot of income, but what the government of Canada did, for right or for wrong, I don't know, you can debate it on both sides, they replaced all that income with transfers from the federal government to the households. They didn't go through the provinces, they didn't go through the municipalities. They went directly from the federal government right to the household, partly because they wanted to do it quickly. But they didn't stop there. What they did was then they took the dollar that people had lost and they added another dollar on top of that, and they gave them $2 on average for every dollar that they'd lost. And then, surprise, surprise, people took that money and some other, in the case of young people, maybe a co-signing mortgage with the grandparents or the parents, and they went out and bought real estate with it. So it's just, so what the catalyst, generally it's a recession is what I'm trying to say in a long-winded way. And now we've had the worst recession since the 1930s, and it didn't correct. So you could either say, well, it'll be something else, or you could say it'll never correct. Now, I would not be in that camp. I would not say that it'll never correct. There's too much evidence of all of these bubbles bursting eventually one way or another. But it'll have to take something extraordinary, I guess, if a recession like that wasn't able to do it.
Thanks for that, Hilliard. I think with that, we have about 10 more questions in the sidebar, but I think with that, we'll wrap it up for today. I just wanted to say thank you very much for coming out and speaking to our group this morning. I think it was a really well-received presentation. There was a lot of value for the people here. Do you want to just put up your contact information and maybe plug your book, or I know you were working on a podcast and some other things. How do people find you, Hilliard?
So if you go to the website there, you can sign up for the weekend notes. That's probably one of the best ways to do it. And of course, you can email us, hilliard.macbeth@richesonwealth.com. We don't have that on here, but it's pretty easy to find. And then on Twitter, I don't know how many people are on Twitter, but I find Twitter quite interesting, and I'm active on it every day. So any one of those ways, just get a hold of us. And I think we will start to do podcasts. There's a regulatory hurdle I have to get over, because they like to pre-approve what I say. Well, if you're on a podcast and if you like to talk like I do, and you start getting going on debt bubbles and all that, who knows what I'm going to say, right? But we did get through the book challenge. We do get the weekend note out every week with the regulatory approval. So we'll find a way to do the podcast, and I think that'll be quite interesting. So there's lots of information available. But having said all that, I really encourage people to read the book. There's a lot of information in the book that explains how do we get into these repetitive bubbles and bursting of bubbles? What is the system that is in place that allows that to happen? And of course, the next question would be, well, why doesn't somebody do something to stop it? Because obviously people love the bubble because their house price, goes up fourfold in 20 years, but they hate the crash that comes afterwards. So would it not make sense, when you have the Bank of Canada, the Government of Canada, the Bank of England, the Federal Reserve, would it not make sense for all these people to get together and prevent these bubbles? So I explain in there why they're not able to do that. And I think it'll be very interesting to all of you if you get a chance to read the book.
Okay. Great. Well, thanks very much, Hilliard. Thanks to all our guests for coming out this morning. And any final comments from you, Joe? Are we good to go?
I think we're all very good. Thank you all very much for coming out. Really appreciate it. It's exciting to see a whole big group come out. So you guys all have a great week. Take care then.
Thanks very much, sir, Mr. MacBeth. Can I say that?
Thank you.
Have a good one.